Welcome to this explainer. I am absolutely thrilled to share this with you today. We're looking at a complete, structured blueprint for your financial life. Think of it as the ultimate wealth architecture. But hey, before we start building, we really need to take a stark look at the cash currently sitting in your pocket. Because, well, the ground beneath our feet, it's shifting fast. For about 80 years now, the US dollar has been the undisputed global king. You want to buy oil? Do international trade? The dollar was your default, no questions asked. But behind the scenes, that reality is kind of fracturing. I mean, over the last few years alone, trillions of dollars have been printed, which severely dilutes the currency's real value. And the scary part, BRICS nations, we're talking Brazil, Russia, India, China, and South Africa, they're aggressively bypassing the dollar. Passive paper money is quietly but surely losing its power. So what does this mean for us? It means you literally cannot afford to just hoard cash anymore. We're witnessing a massive global shift right now. Nations are increasingly trading in local currencies and scooping up gold just to bypass the inflating dollar. And when paper money loses trust on a global scale, you better believe that inflation trickles down directly into your savings account. These macro shifts are a huge wake-up call. They show us exactly why we need a mathematically sound system to actively build and protect our wealth. Just stuffing cash in a mattress, that's mathematically guaranteed to make you poorer over time. So, here's our agenda for this explainer. We're going to cover the macro context, the financial ladder, a deep dive into real estate versus stocks, a pretty brutal midlife financial audit called the 45 milestones, and finally, strategy overlook. Let's get right into it. Section 1, the macro context, the paper money problem. Section 2, the financial ladder, where we learn that order matters way more than assets. Okay, so here's a wild truth. The order of your investments actually matters far more than what you're investing in. Picture two 25-year-olds, right? One is obsessively day trading stocks, while the other just boringly follows a rigid sequence of accounts. By the time they're 45, the one following the sequence has nearly twice the wealth. It's crazy. This 6-step ladder is what separates the wealthy from everyone else, and it starts at the very bottom with a humble $1,000 starter emergency fund. Why? Because a broken-down transmission shouldn't force you to raid your investments. It's a tiny but absolutely vital firewall. Moving up the ladder, step 2 is where the magic happens. Seriously, if your employer offers a retirement match, capturing it is an immediate, risk-free, 100% return on your money. Even if they just match 50 cents on the dollar, that is literally free money sitting on the table before the market even opens. There's no crypto, no real estate, and no stock pick that will ever reliably hand you that kind of return on day one. Then, further up at step 4, after you've knocked out your high-interest debt, of course, we hit an absolute financial superpower, maxing out a Roth IRA. Here's how it works. You put in after-tax money, it grows, and then when you withdraw it in retirement, you pay zero taxes, none. You could yield $1.6 million over 40 years of compounding and owe exactly $0 to the government on those gains. How incredible is that? Section 3, real estate versus stocks. Let's look at the 20-year math. The ultimate dinner party debate. Buying a house versus renting and investing the difference. Let's look at the savage reality of the math here. Say it's 2004, and our homeowner puts $60K down. Factor in all the hidden costs of homeownership, taxes, maintenance, the whole shebang, and their true monthly cost comes out to $2,090. Now, our renter, they put that exact same $60K into index funds, rent a place for $1,550, and religiously invest the $540 difference every month. Fast forward 20 years, the homeowner nets about $397,000. Not bad, right? But that disciplined renter, their portfolio exploded to a staggering $860,000. But hold on, because there is a massive psychological catch here. The uncomfortable truth is that the mortgage acted as forced savings. The bank demanded that payment every single month, no excuses. The stock investor, on the other hand, had to have flawless emotional discipline to keep investing that $540 through the terrifying market crashes of 2008 and 2020. So, on pure, cold math, stocks win. But on human behavior, real estate often forces the discipline that we naturally lack. Moving to Section 4, the 45 milestones, the midlife audit. Age 45 is basically your last major checkpoint before the financial runway starts getting a little short. So we're going to look at some unsugar-coated numbers. But first, we really have to define net worth properly, because confusing what you own with your actual net worth is a massive trap. Your net worth is your assets minus your liabilities, period. If you own a gorgeous $200,000 house, but you have a $200,000 mortgage on it, your net worth is exactly zero. It's only what you hold free and clear that counts as wealth. So, what are the targets we're aiming for? Well, for growth by age 45, your net worth should be at least 3 times your annual income. And your dedicated retirement accounts, those should also hold 3 times your salary. Once you hit this multiplier, compound interest is finally doing the heavy lifting for you. It's like the engine is running while you sleep. You also want a housing cost that isn't totally eating your life, and ideally, the beginnings of a secondary income stream. Now, you might be wondering where that specific retirement target comes from. It's actually based on the famous 4% rule. Basically, to retire at 65 and maintain your lifestyle, you need 25 times your annual expenses saved up. This ensures your investments have enough growth momentum to sustain a 4% withdrawal rate over 30 years without running dry. And having 3 times your salary by 45? That's the exact mathematical trajectory you need to be on to hit that final target. But your defense has to be just as strict as your offense. By 45, you absolutely need a fully funded, liquid 6-month emergency fund. And I don't mean a little buffer. I mean an actual 6-month wall of cash. You also need airtight insurance, especially disability insurance, because statistically speaking, you are far more likely to become disabled than you are to die before retirement. Without a solid defense, a single unexpected medical event or a sudden job loss becomes a single point of failure. It can completely dismantle decades of your hard work. You want to know the absolute worst structural leak in your financial defense? Credit cards. The average interest rate is a staggering 21%. Think about that. When you carry a balance, you're just bleeding 21 cents on the dollar, completely risk-free for the bank. Let's put that into perspective. The stock market averages about a 10% return a year. You would have to beat the historical stock market average by more than double just to break even. You literally cannot out-invest high-interest debt. You just have to eradicate it. Section 5, Strategy over Luck, the final verdict. So when we bring this all together, the big takeaway is that wealth isn't about finding secret, hidden investments. It's not about just getting lucky. There's a great quote that hits the nail on the head. The winner is not the asset class. The winner is the behavior. Whether you leverage the forced savings of real estate or you take the highly disciplined approach of investing in index funds, it is your behavioral consistency over time that actually wins the game. The person who quietly and persistently follows the sequence is always going to outperform the undisciplined genius. Every single time. We've based a lot of our math today on the last 2 decades. And let's be honest, those years enjoyed massive economic tailwinds and plummeting interest rates. So, as global dynamics continue to shift, I want to leave you with this to think about. If the next 20 years look nothing like the last 20, are you just relying on a long run of luck? Or do you have a cold-blooded strategy in place? The sequence works, but at the end of the day, you have to be the one to actually execute it.